Good morning, distinguished experts and colleagues. I'm Wu Hongyi from North China University of Technology. Today, I will analyze the dynamic linkage between international gold prices and the US dollar index using a threshold VAR model. Now, please join me as we delve into this presentation. This presentation is organized into 9 sections, progressing from theory to empirical analysis, and from model building to conclusions. We begin with research background and motivation, then literature review to identify gaps, then theoretical analysis and hypotheses, then TVAR construction and data pre-processing, then regression estimation and impulse response analysis, and finally conclusions with policy recommendations. References are listed at the end. In 2025, China's gold import dependence reached 59.9%. Meaning that more than half of domestic consumption relies on imported supply. Moreover, since 2012, China has ranked first in global gold consumption for 13 consecutive years, with domestic demand maintaining strong growth. Given that gold is dollar-priced, the high import dependence means dollar fluctuations significantly impact China's gold market. Gold also has commodity, currency, and safe haven attributes, so price movements affect investor returns and spill over to the financial system. This provides a solid real-world foundation for studying the relationship. Dollar appreciation and depreciation do not affect gold prices symmetrically. Under different dollar index regimes, market risk appetite and capital flows differ, causing the impact of dollar shocks on gold to vary markedly. The conventional wisdom that strong dollar means weak gold is not always true. Sometimes the two move in the same direction. Linear models cannot capture this non-constant relationship, so we use a nonlinear threshold model. We focus on 2 questions. 1. Is there asymmetry between high and low dollar regimes? 2. Does this hold for both dollar appreciation and depreciation shocks? Early work by Capi et al. Found that gold's hedge against dollar depreciation varies over time, and the relationship is not constant linear. Tully and Lucy, using Paragarch, first verified asymmetric macro effects on gold returns. Shostak clarified the link between post-Bretton Woods flooding rates and gold price volatility. Later research moved beyond linearity. Jin and Nyan first confirmed complex nonlinear interactions. Feng and Zhang showed that the dollar exchange rate dominates gold futures price forecasting. Riboredo used copula models to verify gold's hedging ability under different market conditions. Zhao's latest work confirms nonlinearity and explicitly states that the relationship is regime-dependent. The existing literature has 3 major limitations. First, most studies use linear models and cannot capture regime-dependent features. Second, few studies distinguish linkage heterogeneity between high and low dollar regimes. Third, there remains a gap in daily TVAR analyses covering 2011-2025. However, frontier research provides support. He et al. Confirmed state dependence and a thinly verified asymmetry in gold's safe haven property. Building on these, we use a 2-regime TVAR with long-span daily data to fill these 3 gaps. Reviewing the trends of the dollar index and gold prices from 2011 to 2025, we identify 5 distinctive historical phases. Low dollar cycles correspond to high gold prices, while strong dollar cycles are accompanied by sustained gold price declines. During trend reversals, they still maintain a negative call movement. Overall, the trends confirm that the relationship is dynamic, providing intuitive evidence for testing our asymmetry hypotheses. The dollar index affects gold prices through 3 core channels. First, the pricing effect. Since gold is dollar-denominated, dollar moves directly change its dollar price. Second, the safe haven substitution effect. Dollar strength drives investors toward dollar assets, crowding out gold demand. The capital flow effect. A strong dollar attracts capital into dollar assets, diverting funds from gold. These channels are nonlinear, hence we propose the hypothesis. H1 dollar appreciation hurts gold more in low dollar regimes. H2, this asymmetry exists for both appreciation and depreciation, with low regimes amplifying gold's responses. We employ a 2-regime threshold vector autoregressive TVAR model. The threshold variable is the first difference log return of the dollar index. The threshold is endogenously estimated by grid search. The threshold lag is set to 1, and the lag order is chosen by information criteria. This framework effectively distinguishes low and high dollar regimes and captures dynamic heterogeneity. The sample period runs from the 4th of April 2011 to the 30th of December 2025, with daily data yielding 3,696 valid observations. This long span covers full dollar cycles and multiple extreme events, enhancing statistical power and external validity, and meets the sample size requirements for threshold modeling. The raw level series are non-stationary, so we take first differences of logarithms. After this, the variables become stationary at the 1% significance level. The estimated VAR is stable. All inverse roots lie inside the unit circle, so impulse response analysis is statistically valid. This ensures both statistical validity and economic interpretability. Different information criteria give different lag orders. AIC supports lag 2, while BIC and HQIC support lag 1. We ultimately choose lag 2, which fits the short-term dynamic transmission of daily financial data, and residual tests show no significant autocorrelation. The threshold variable lag is set to 1, meaning that today's regime is determined by yesterday's dollar return. Using grid search, we estimate the optimal threshold gamma for the dollar index return series as 0.000190, which is close to 0. Based on this, we define two regimes. If the lag dollar return is less than or equal to gamma, it is the low dollar regime weak, stable dollar. If greater than gamma, it is the high dollar regime appreciation pressure. This fine division helps capture distinct dynamics under each regime. The table shows the full TVAO regression results. P-values are in parentheses, with asterisks indicating significance levels. We focus on the gold price equation and the dollar index equation. All core coefficients in the gold equation are significant at least at the 5% level, so the results are statistically robust. The regression results verify the heterogeneous impact of the dollar on gold. In the low dollar regime, a 1% rise in the lag dollar return causes gold returns to fall significantly by 0.1619%, and this effect appears only on the first leg, a quick one-day suppression. In the high dollar regime, the same depressing coefficient drops by over 50% to 0.0720 and is not statistically significant. In addition, the dollar's on lag terms are significantly positive at 1% in both regimes, confirming strong persistence in dollar volatility. Specifically, in the low dollar regime, the coefficient is 0.1619, significant at 5%, with strong impact and a convergence period of about 6 days. In the high dollar regime, the coefficient is only 0.0720, insignificant, with impact intensity only 45% of the low regime, and convergence in about 4 days. The core conclusion is clear: dollar appreciation suppresses gold twice as strongly in low dollar environments. The asymmetric threshold effect is empirically confirmed. Under the high dollar regime, a 1 standard deviation dollar appreciation shock leads to an immediate negative response in gold, peaking at 0.07 on day 1, then decaying quickly and converging to 0 by day 4. No long-term effect. This matches the regression. The effect is small and statistically weak, and the market absorbs it fast. Under the low dollar regime, the same appreciation shock gives an immediate negative response, reaching a peak of 0.16 on day 1, more than twice the high regime peak. The decay is slower, converging around days 5-6. Also, the confidence intervals are wider in the low regime, indicating greater uncertainty in the response magnitude. This confirms that low dollar conditions amplify both the size and persistence of the shock. Under the high dollar regime, a dollar depreciation shock leads gold to rise on impact, with a peak response of about 0.07, and the effect decays by day 4. This response is symmetric to the appreciation shock in the same regime. Thus, in the high dollar regime, dollar movements have a weak and symmetric effect on gold. Under the low dollar regime, dollar depreciation pulls gold prices up, with a peak response of 0.16, again twice that in the high regime, and the effect lasts for 6 days, compared to 4 days in the high regime. This asymmetry holds for both appreciation and depreciation shocks, fully validating both of our research hypotheses. The direction of the effect is consistent with classical asset pricing theory. Across all 4 scenarios, a clear pattern emerges. In low dollar regimes, gold's response to any dollar shock is twice as large, and it persists longer. This asymmetric amplification effect is the core empirical finding of our study, breaking the homogeneous conclusions of traditional linear models, and confirming the nonlinear dynamic relationship between the dollar and gold. We find a significant threshold effect. The optimal threshold divides the market into two regimes with completely different dynamics. In the low dollar regime, dollar movements affect gold more than twice as strongly, in the direction predicted by theory. All dollar shocks on gold converge within 10 trading days, indicating that the correlation is only short-term, with no long-term trend influence. Regulatory authorities should improve cross-market early warning systems that integrate gold and dollar price dynamics with macroeconomic, policy, and geopolitical information to capture regime switch risks. Based on the asymmetric effects found here, differentiated alert thresholds should be set, with higher sensitivity to dollar moves during low dollar cycles. During regime shifts, policy intentions must be clearly communicated to avoid panic overshooting in gold prices, and international policy coordination should be strengthened to enhance global gold market regulation. Market institutions should develop gold derivative hedging tools tailored to different dollar regimes, incorporate heterogeneity sensitivity parameters into risk models, and strengthen supervision during cyclical transitions. Individual and institutional investors should build regime-match strategies in low dollar regimes, control positions to reduce volatility. In high dollar regimes, use gold safe haven function. This study reviews 2 decades of academic evolution, from early linear relationship tests to recent explorations of nonlinear and heterogeneous effects. Core domestic and international literature provides a solid theoretical and methodological foundation. Our conclusions build on existing achievements while extending the threshold via a framework with regime-dependent response asymmetry. Dear colleagues, thank you for your attentive listening. Through our TVAR empirical analysis, we have clearly revealed a significant threshold effect in the low dollar regime. The impact intensity of dollar movements on gold prices is about twice that in the high dollar regime, and all shocks converge within 10 periods, with no long-term trend. This conclusion gives precise quantitative guidance for regulators in building cross-market monitoring, for financial firms in risk management, and for investors in asset allocation. Gold, with its multiple roles, remains a key asset, and our work deepens understanding of its link with the dollar. We welcome your questions and comments. Thank you.